Volume growth and efficiency initiatives aided a strong quarterly performance from Dr. Lal Pathlabs. The top line too was aided by non-NCR markets and better realizations. Let's discuss the quarter gone by with Om Manchanda. He is the CEO of Dr. Lal Pathlabs. Mr. Manchanda, thanks very much for taking out the time. A good set of numbers. It looks like the bottom line has been aided well by the effective corporate tax rate cuts. But I wanted to know from you specifically with regards to SwasthFit. The contribution to overall revenue fell from 22% in quarter 1 of FY20 to 15% in quarter 2 of FY20. Could you highlight that for us and the reason for that?
How much you said in the first quarter growth rate?
No, not growth rate. Contribution to overall revenue from SwasthFit.
Oh, okay. So contribution from SwasthFit is about 15%. This contribution is very similar to what we had in quarter 1, but we continue to see a good growth from this segment, and it remains a priority segment to drive growth. And we hope to sustain the same momentum in times to come as well.
Your core growth regions, sir, this quarter were NCR and Kolkata. Are you looking to expand in terms of geography? So this is going to continue to remain the core areas for you. And what kind of growth can we anticipate for the next quarter?
Yes, that's a good question. So you can actually divide our business into two parts. One is, of course, Delhi NCR, which is our core market, traditional market. We have been here for ages. And the second is rest of India. And historically, we have done very well in Delhi NCR. It contributes handsomely to our bottom line as well as top line. But for the last 3-4 years, in addition to consolidating our position in Delhi NCR, we have been focusing quite a bit on rest of India, consisting of rest of North, East, and rest of other parts of the country. We built a very big reference lab in Kolkata about 2.5 years back. Now, as a part of our strategy, we want to expand our presence in Western markets. We are looking at expanding our footprint into South and West. A lot of efforts are going in this direction, both organically as well as inorganically.
Realizations this quarter improved per patient. I think it came in at 687 rupees from 669 rupees. What aided this?
This primarily actually is built on because last year, same quarter, we had a lot of BTL activities. So that added to our patient base, but we didn't have much realization from there. So I think there is a base effect that is showing up here. But this revenue per patient growth rate, we don't see coming in times to come. But primarily, our top line growth will be driven by volume growth. That's the way we look at it. We don't want to really look at the revenue per patient as much as what we would like to see on volume.
All right, so volume was higher by 12% year on year. Is that a benchmark to go by for the upcoming quarter, or you could do better?
Yeah, so I don't want to give a specific guidance for the quarter, but on a long-term basis, we want to see growth rates in this similar range as we have seen.
Mr. Manchanda, I think the focus of the company has also been on sustaining the margins, and we have seen margin improvement in the quarter gone by, around about 30% versus 27.5% that we had seen in same time last year. But you also expanding now from the Delhi non-NCR region, and the margin from those areas has been lesser. Do you think that can be a threat to your overall blended margins on a yearly basis?
Yeah, I think that's a good question, and as a team, we have been focusing on this as we transition towards higher contribution from rest of India. Obviously, we have to keep an eye on what happens to margin. So far, we have managed it well. A lot of focus is going on productivity and cost optimization, and we hope to continue to sustain these margins. But I would say that it will operate within the range, and we have been indicating between 25 to 27% EBITDA margin as we go forward. But so far, we have managed our costs better. But I think you're right. As the contribution from rest of India goes up, one has to keep an eye on the margin as well.
So 25 to 27% is the guidance that you're giving us for this entire financial year, right?
No, sorry, this is not for the financial year.
Okay.
I'm actually saying more 3 to 5 years perspective.
All right, for the next 3 to 5 years. Give us a sense on the pricing then. I think there was some marginal prices which were, there was an increase seen in Delhi NCR region by the end of June quarter. Did it last in the September quarter? Was there any value growth seen on back of that?
It's very marginal, so it's nothing much. It's not very material stuff, but we did take a small price rationalization in Delhi NCR where we took some prices up, some prices down. But I think that impact is very marginal, so it's not really material for me to share right now.
So the focus remains on sustaining margins. The focus remains on volume growth, as you've seen. So going ahead in the second half or even the next financial year, can we expect rationalization of prices then from the company?
See, our objective will continue to remain focused on volume growth and make sure that our price-value equation is competitive, remains in our favor. For that, essentially, we'll have to pass on whatever benefits we get on account of cost saving to the consumer. So that effort will continue, and as I keep mentioning that we will have to really drive volume growth to drive top line.
Correct me if one last question. Correct me if I'm wrong. Is the second half for you all weaker than the first half that we've already seen? If yes, then what sort of growth one can expect in the second half?
Generally, I think you're right. Our second half is slightly softer than the first half because Q2 is only the highest quarter for us. So if you look at historical trends, normally it's about 49.5% versus, let's say, first half, which is about 51% kind of breakup.
Okay, Mr. Manjanda, one last question with regards to your plans to grow inorganically. You've obviously completed. You've acquired 70% stake in Amin's Pathology in Vadodara. You're also scouting for potential partners in Pune and Bengaluru. How far has that gotten in terms of getting prospects to acquire, and what kind of growth do you anticipate coming in through this inorganic route? Also, part two of the question being is the market is factoring in an ROC growth of about 35% for you in terms of an ROC profile. Do you think that's a bit of a tall ask, or you'll be able to meet it?
So I won't like to comment on ROC, but as far as the inorganic piece is concerned, this industry or this space is highly fragmented. There are a lot of unorganized players. 85% of the market comes from the single lab owners, and that's where a lot of gap is, both on quality as well as on service. And we believe that in addition to what we are already doing on the organic front, there's a very large opportunity of consolidating the market, though one can do better. But global experience suggests that the inorganic piece is one can't really turn a blind eye to this. As an organization, we are focusing on both the cylinders. We want to make sure that both fire. And in this direction, inorganic, we have done a couple of acquisitions, and we'll keep scouting for good quality assets and see how we can expand our presence, especially in South and West markets. So those efforts will continue. Let's see how it goes.
Right, Mr. Manchanda, we leave it on that note. Thank you very much for joining us this afternoon and detailing out your quarterly performance and also the outlook for the upcoming quarters.